10 stocks can still offer a pretty good level of diversification, particularly if they are through well-dispersed sectors and themes. From academic research papers we look at, going beyond 30 stocks limits the amount of diversification benefit you get beyond that point, but certainly from 15 to 30, you're having diminishing returns from further diversification in the portfolio. If you've got 300 holdings in your portfolio, there's very little chance, even with the help that AI can bring you, to stay on top of exactly what's going on in the portfolio and what's doing what. Whereas with 10 stocks, you can have a much more concentrated and also purposeful allocation to each one.
Hello, everybody. Welcome to the Mouthy Money podcast. Very excited today to be introducing episode 2 of Investing Stakes in partnership with Stratiphy. Now, in the first episode, which you can catch on our YouTube channel, we looked at Stratiphy and how Chris and I were putting our money where our mouths are and investing £500 each on the Stratiphy platform. I'm joined as ever by Chris Tuite, who is my co-host and now competitor in this process. He is head of consumer finance at communication consultancy MRM. And I am also joined by Chris Ling, who is chief investment officer at Stratiphy. Hello, both. How are you doing?
Yeah, hi, good. You could see.
Brilliant. So what we're going to do in this episode today is we're going to start off by having a bit of a look at how we've set up our portfolios now, because they are now live and running, I am pleased to report. We're also going to look a little bit about some of how those portfolios work on the Stratiphy platform and app. We're also going to get Chris L to do a bit of an update on what's been going on in the first few weeks as our portfolios have been live. Then we've got some interesting stuff to discuss around what one of the big themes has been in markets in the past month or so, and that is the SaaSpocalypse, the SaaSpocalypse, what that means for investments and the markets at the moment. Then we're going to go on and look a little bit at what's holding back some of the US market at the moment, why other areas like the EU and UK look a little bit healthier, shall we say, in terms of performance and why that might be. Some of the considerations around index investing, so passive investing, that can have for people's investment, long-term investment portfolios. Then we're going to finish off with a little bit of a preview of what comes next and some of the holdings that we're going to be focusing on in future episodes. Now, let's not waste any time. Chris T scores on the doors. As of the time of recording, you've invested £500. What has that translated to? And now I think it's about 2 weeks of live portfolios, right?
Yes. It is 2 weeks. Yeah. Well, do you want the excuses or just the numbers?
Look, I'm a numbers guy, Chris, today. I'm a numbers guy.
Okay. 0.9% growth over that 2 week period. It seems. So that translates to a whopping £4.48 in profit. But the app, Stratiphy app, is telling me that is 3.25% below market. And I think a lot of the reasons we'll come on to for that is probably because I'm quite heavily weighted in the US. And there's been a little bit of what would we call it? A reversion, a correction, a tick downwards over there. So, you know me, Ed. I look to a longer term than 2 weeks. So we're in the green, which is good. There's profit, but it's probably been a little bit tempered by events.
Yeah, of course. So obviously we are advocates of long-term investing here. Now we are looking at very short time horizon at the moment. We're just illustrating the ups and downs that markets makes. And I think it's important to follow the trends, but stay invested, which is our plan for the entirety of this series and why we're following along. Now, Chris Tuite, my portfolio, I am pleased to report, has returned a healthy £15 at the time of recording.
Oh, wow. Okay. That's quite a change from when I spoke to you earlier this week, Ed. What's happened?
I've taken a little bit of a tick up, 3.13%.
Okay.
In 2 weeks. Now, I think there's been a few kind of interesting performers in there that Chris L's going to and potentially talk to us a little about. So let's break down a little bit what because obviously the Stratiphy platform, when we invested, we don't pick stocks ourselves. We picked our strategies and what we wanted from those and kind of areas that we wanted to invest in. But the Stratiphy app has, and the algorithm has picked specific stocks for us. So, Chris T, what are some of your kind of notables that you've got in yours?
Notables, right? Well, my best performers has been Assurant, which I believe I'll go in and tell you what these are. My best performers have been Halma, Assurant, and Marathon Petroleum. So I made a note here about what each one of those are. So Halma is a global group of safety technology companies. So it makes sensors and hazard detection systems, environmental monitoring equipment, and medical devices, all aimed at safer, cleaner, healthier outcomes, apparently. So that is quite interesting, really. So it's more in that kind of industrials and engineering space. Marathon Petroleum is in energy and utilities, which is another area that I've got some exposure to. So they're a major energy company that operates refineries, pipelines, and focuses on fuel refining and distributing and all that kind of stuff. So again, that's quite interesting in terms of that infrastructure play that I was looking at when we spoke last week. And then who was the other one? Assurant. So Assurant, I believe, is a life assurer. So a global provider of insurance and risk management products, especially in niche areas like mobile device protection, extended warranties, renters insurance, and lender-placed insurance. So broadly speaking, my sort of 10 firms are spread across industrials and engineering, energy and utilities, healthcare and life sciences, real estate, and financial services. So I've gone a bit old school with my stuff. Read the tech show we had last week.
Yeah, and your strategy was to kind of be quite tech allergic, wasn't it? So you don't really have any.
I wasn't that taken in by the sort of AI stuff. I don't think that we know how that's going to play out. Look, it's going to play out in one way, shape, or form, but how disruptive that is kind of like brand new technology that we don't fully understand yet, from what I can understand from the public discourse around it, that is being deployed in ways that we're not fully cognizant of what the impacts might be, and we don't have economic modeling to suggest what the impacts will that be with any great certainty. Not that we can ever be certain about these things. So I've decided to just take a step out of it altogether and go back to the kind of old school hard assets, if you like, around, engineering, industrials. But there is a little bit of financial services in there because I'm biased towards that with the job that we do and feel like I understand it. A little bit of real estate, and healthcare was another one as well. So yeah, I'm interested in those firms. I'm interested they're all US as well, even though I look to do a kind of combined US UK thing. We'll see how that works out over the long term. But yeah.
So for my own, I do have some tech. Now I've got quite an interesting situation in my portfolio. The better performers have actually been miners. So Antofagasta and Endeavour Mining have done pretty well. Another one called Cummins, which is a producer of diesel engines in the US, has done a manufacturer, I should say, of diesel engines. But I thought what was quite interesting in my portfolio, and Chris L, you've got a bit of insight on this, is I actually have two versions of Alphabet. Alphabet obviously being the owner of Google. Now, I'm not necessarily opposed to that because I'm quite positive on how I think Google will do in the kind of broader AI and tech race and this sort of stuff. Why would I end up though with two alphabets in my portfolio though, Chris L?
It's actually fairly simple, really, in that both share prices for Alphabet for the voting or non-voting shares really pretty much follow each other. So they're going to have the same sort of signals, and unless we proactively exclude one over the other, then if it's good for one, it's going to bring in both. Now, it does in the US market, it's got one of the strongest signals, I think, out there. So having it in twice, you might say, well, it's a bit of a lack of diversification, but it is also at the same time a strong punchy position. So it's could be a plus again, but you're adding concentration risk because really there's little diversification between the two of them. So it is one where it could work either way, but it's one to quite like potentially. So I don't want to say that's wrong, but
we're we're going to look a little bit more widely at the stuff around the SaaSpocalypse and AI threat to specific stocks and this sort of thing, because that's been a big story in markets in the past few weeks. On that concentration point, it's quite interesting. I know you've our strategies have been set up so they've got about 10 stocks each, I think, haven't they? And that's also I must also actually mention that we've also set up a stratified baseline portfolio to run alongside both Chris and mine as a kind of benchmark for us to work against, which we'll be going into a little bit more detail, I think, in a later episode, just to look a little bit more reflectively at that. But just thinking about concentration, Chris, that 10 is quite concentrated, isn't it? Is there a rule of thumb for what a good number might look like in a portfolio?
Yeah, I mean, each strategy isn't necessarily designed to be somebody's entire wealth, or whatever, but potentially part of a larger portfolio where you're trying to construct something together. But 10 stocks can still offer a pretty good level of diversification, particularly if they are through well dispersed sectors and themes. And I think, with the exception here of Alphabet coming in twice, but it is, I think, your only tech stock out there. And you think what tech is a capitalization in the world at the moment, it is at least, I think, a quarter, perhaps a third of the global market cap. So actually, for somebody who's having that significantly as part of the strategy, it's actually not particularly out of whack with the broader world. I would say generally, from academic research papers we look at, going beyond 30 stocks kind of limits the amount of diversification benefit you get beyond that point. But certainly from 15 to 30, you're having diminishing returns from further diversification in a portfolio. And, many portfolio managers will have, 50, 60 stocks, and, an index fund will have potentially thousands, but the actual diversification benefit you get at the margin for each of those stocks become much smaller, and therefore having a concentrated portfolio, particularly if you're trying to stock pick or go with a particular theme, will give you more differentiation and more ability to stay on top of what it is that you're actually holding. Whereas, if you've got 300 holdings in your portfolio, there's very little chance, even with the help that AI can bring you, to stay on top of exactly what's going on in the portfolio and what's doing what. Whereas with 10 stocks, you can have a much more concentrated and also purposeful allocation to each one.
Yeah, interesting. Now, obviously, one of the unique propositions of the Stratiphy strategies is that the strategies will rotate your holdings depending on kind of the data and the sort of the differentiation in performance. So just before we move on and look at the wider context of what's going on out there in markets at the moment, just talk us through that a little bit, how that rotation works for the strategies and what we can expect in the month ahead for our own strategies.
Yeah, and I think because you've got two different strategies, the way they work. So Ed, correct me if I'm wrong, but yours is the moving averages strategy, and Chris is on the momentum strategy. They've got two quite different setups. So with momentum, you've kind of it's typically based off the last 6 months of performance, and that can lead to potentially quite a few changes in the portfolio. So it's really and it will depend on whether you're adding money regularly or if you're just holding the amount of money you've got in the account, because what the portfolio optimizer is going to do with new cash compared to whether it's going to sell something and buy something new, there's a bit more of a hurdle to actually sell a stock and then buy something new. So the momentum signal has to be weak enough to sell something that's into something that's much stronger. Whereas with new cash, it's just going to treat it as, well, what is the best 10 things I'm going to buy with this new money? So you might see, if you did add money over the next month or two, that what it does is actually add more diversification in the portfolio, because the 10 best signals at that time might be quite different to what they are at the start. But that doesn't necessarily mean that the monthly rebalance as we go through the portfolio, that doesn't necessarily mean that it would normally sell all 10 stocks if you had 10 new signals as being the best, because it doesn't necessarily want to, having taken into account trading costs and the sort of friction that you get in rotating a portfolio, it doesn't necessarily want to sell all those 10 stocks either. So to give you an example, over the last 12 months, my momentum strategy only actually sold one stock. Interestingly, that was Hikma Pharmaceuticals, which is now back in Chris's portfolio. So that's not necessarily an indication that momentum always works. So it sold it having had some negative momentum at the time, and that stock was sort of down 20%, but it was cutting its losses. Now it's regained that momentum clearly. So it's working its way back in. On the moving averages strategy, though, on yours, Ed, you might see slightly less. I mean, it really does depend on how the stocks perform, but you're looking at something like, how is the short-term stock performance, or relative short-term, of a 50-day moving average compared to its longer-term 200-day moving average? So it's kind of like comparing what the short-term is doing against the mid-term momentum. And whereas momentum is just purely what is that sort of half year looking like compared to other stocks, this is looking at trading signals. So when a positive signal for your moving average is going to be when that 50-day moving average is now moving above the 200-day moving average. It's got an increasing line there of sort of increasing kind of momentum to the stock. So it's a buy signal to get into something. And then equally, if that 50-day moving average drops below the 200, then that's kind of a weaker signal to maybe this stock is peaking and time to get out. So depending on exactly how much those stocks move, you possibly expect slightly less movement between your stocks, Ed, in your portfolio, because it will tend to wait for those signals to go negative. Whereas in momentum, there just might be other more positive stocks that it wants to trade into at any one time.
Now let's look a little bit at the market backdrop here, because it's quite granular looking at our portfolios, and obviously we have things haven't been moving huge amounts in the past 2 weeks, but there is a lot going on out there at the moment, isn't there, Chris? Just give us a bit of a quick rundown on what the state of investing markets are at the moment.
Generally speaking, markets so far this year have had a pretty strong start, and the strongest start has been in the rest of the world, not America. So America, we've broadly seen keeping flat, and the rest of the world being broadly positive. The UK's been a very strong position in the last couple of months, and then more recently in the last few weeks, Japan, following the elections, has had a good spike up in their markets as well. Buoyant in the news that some more expansionist economic policies that coming into play there might be more positive for their overall equity markets. Slightly more neutral on the bond side of things for Japan, and over in Europe and emerging markets generally, they've also seen fairly positive moves, although I think UK and Japan probably the strongest of the two. US otherwise has been pretty flat, and part of this might be down to the US government with its international policy of, first we've seen some interest in Venezuela, moving on to then Greenland, and now we're looking at Iran and what interesting shenanigans might go down that way. Who knows what posturing might turn into anything or nothing. But I think that kind of nervousness generally around some of the more geopolitical consequences that they're coming off the back of the US. I think a lot of institutional asset managers started to rebalance their portfolio, kind of re-risking the US. And we saw a lot of that last year. Yeah, there's certainly some rebalancing being done around global portfolios, where suddenly the US doesn't carry that same premium that it perhaps did a couple of years ago.
Now, there's an interesting point here with that kind of re-rating of the US and beneficiaries being places like UK, EU stock markets. Generally, kind of money flowing away from the US more towards other places. And this is something that I think about quite a lot, because setting aside the Stratiphy portfolio at the moment in my kind of pension is, I put my pension basically in a global index tracker, a passive fund index tracker. Does that create, because it can create an issue, right, where if you're in a global tracker, you're very heavily exposed, I should say, to the US in particular, and those index funds can have a bit of a lag on their kind of rebalancing and this sort of thing. So can there be an issue there for some people, or should people just generally just ignore it? I mean, what's at play there?
Yeah, so I mean, there's a good few points to make, I think, in this. So depending on which index exactly you look at and how they've kind of sort of defined it or come up with it, but maybe you want to look at the US and just say that's roughly 2/3, just under 2/3 of the global stock market. So it doesn't necessarily need a huge rebalance. It just needs some people in the US to go, oh, hang on, actually, maybe the rest of the world isn't broken and we should put some money outside of it. So it just needs some of that capital that's in America to actually go back to the other third. And then suddenly the other third goes, oh, suddenly people are trying to buy our shares. And so it's starting to pump up demand and therefore the prices. What does that mean if you're in a global index fund? Well, actually, in a pure index fund, you've already got the index, so all you're seeing is the 2/3 is staying roughly the same, and the third is being slightly pumped up. So overall, you're kind of up a little bit. But unless you were proactively selecting which index funds you were in which case maybe you've kind of got index funds that are regional and kind of having regional tilts with them, in which case then you might be benefiting if you didn't have full weight, as it were, as a global index benchmark in the US, and maybe you're only 50% or 40% in the US and 60% in the rest of the world, then actually you're probably doing better than the global equity indices at the moment. As quite a number of people who would be a UK-based investor might have some sort of UK-based UK bias to their allocations, in which case, you've had a really good sort of 15 months or so. Maybe the previous years to that, you've had to withstand some pain whilst you've looked on at the US and gone, hasn't that been nice? But I've missed out. But yeah, suddenly there's a bit more time for UK investors and other global investors to shine a little bit.
Chris T, what's your take on it? How do you feel about this kind of US versus rest of the world? I know I've got reasonably specific views about it that I'll share. I mean, you mentioned there that your portfolio is quite heavily it's basically all US.
I've got one UK stock,
anyway.
which is that Helmer stock. The rest of them are all US.
Okay.
Yeah. So which feels like bad timing based on what Chris is saying, but keep the faith. I think, I'm quite relaxed about it, Ed. Like you say, I invest for the longer term. So we're looking at a longer term horizon than some short term changes on that. I think I'm more concerned about the tech side of things. I know we'll get into that, but I think that's probably going to have a bigger impact on what my portfolio does over the long period of time than the kind of regional differences. Although obviously, like you say, I'm overweight kind of US. So,
Chris, I think that's part of it, though. That you're almost like slightly indicative of what global asset managers are kind of doing a little bit, because they've been seeming or felt so long in Mag 7 stocks in the US and these other US tech stocks, and been just sort of riding the wave of sort of this endless sort of increase in earnings and everything looking rosy there, the investment returns looking good, and everyone's suddenly starting to sober up a little bit and thinking, where does this go? And what is going to come out of the eye? We've got all these US tech stocks, and they're not all AI tech stocks at that either. So suddenly there's a bit of a change in heart, and just to bring the strategies back into this is kind of where momentum is sitting in, and this can work not just for stocks but between regions as well, because it's a slow process, this kind of global rebalancing of what asset managers are doing, because it's not just one asset manager, there's thousands of them doing it for billions of pounds, dollars, euros, or whatever across multiple pension funds and jurisdictions. So it's that big move of capital that can drive momentum for quite long periods of time, and that's how sometimes these seemingly simple strategies can actually be quite effective at riding waves or kind of getting off them at certain points, because you do get these sort of relatively gradual shifts in markets that it's good whilst you're on it, and that's kind of effectively like what momentum is looking at. It's riding the waves, and that's why you're seeing gold miners coming into your portfolios, because gold has been on such a ride, and gold miners are going to be a big sort of like a leverage benefit off that, because suddenly their profit margins are shooting up massively because what they're producing is coming in at two or three times the price it was a few years ago, and that just produces an awful lot of opportunity for the stocks.
Yeah, I'm quite like, obviously there's a lot of political volatility in the US at the moment. Call it what it is, and we referred a little bit to earlier in the episode. But when I think about the longer term in terms of where's a good business environment, who's got a robust system that encourages business, low taxes, lots of liquidity, all this kind of stuff, and it's still very much on America's side in that sense. I would say it's still very business friendly place. I think, and this probably brings us nicely onto the next bit, is there are obviously going to be winners and losers, but there are always winners and losers in investing. That what works nicely with these kind of strategies that work off things like moving averages and momentum is that it takes a little bit of the guesswork out by using that data. Obviously, past performance is not an indication of where things are going in the future, but it's a systematic approach instead of just buying a few stocks and just hoping for the best and not thinking to rebalance at the right time, etc. So this brings me to my point, and which I think is quite interesting about Chris T's portfolio, in that you've got US, but you're avoiding that tech stuff. And that's quite interesting because this idea of the SaaSpocalypse, the SaaSpocalypse, which is software as a service. And there's been a sort of weird, almost seemingly random series of events in the market where suddenly one particular stock will take a 10% hit one day. I think the most recent was IBM, because some very niche Substack published investor note posted something and then IBM's share price just suddenly took a 10% downward turn on the back of that. Chris L., what's going on here with that? Why are some stocks suddenly finding the bottom fall out of their share price, and what's going on?
Yeah, I mean, that's a correction for IBM. Technically, in stock market speak, when you get a 10% drop, and that can happen quite suddenly for a lot of stocks, and that particularly is where you've got stocks where it's really based on what their future earnings potential is going to do. That there's a lot of expectation with IBM, and kind of where the talk was going last year in the US, wanting to recenter their chip manufacturing back at home, that IBM was going to be a big beneficiary of that. So that stock had more than doubled or tripled or something last year, I think, at some points, depending on exactly when you're taking your price measurements. But it's that kind of, it just takes a little bit of somebody to effectively take the shine off, or suggest, is there actually a bit of a reduced chance that future doesn't happen, and then suddenly taking 10% off. And we've kind of seen that with Mag 7 stocks as well. So Microsoft took, it's a huge $4 trillion company, and suddenly it takes a 10% hit to its share price. And talking about SaaS stocks, it's also an AI kind of stock, but very much on a global monopoly on its own SaaS. And yes, it's into cloud computing and everything else like that, and makes huge profits with its Azure services. But its share price over the last year is down sort of 15-20 odd %. So it's part of a bundle of very good tech stocks that have suddenly had where analysts and investors have started to have a bit of a rethink and a bit of a relook at who is going to come out of the AI race winning, and what is actually potentially going to enter into a bloodbath. And nobody's saying, Microsoft business is dead tomorrow, but it's discounting that future somewhat more than perhaps it was 12 months ago.
Yeah, I mean, that's why I'm relatively sanguine about holding my kind of high alphabet concentration. I'm relaxed about it at this point, because if we're talking about this SaaSpocalypse and what's going on here, well, it's individual companies are getting targeted because they're being revealed as kind of not up to the job of competing in this new world of AI. There was one in the UK recently which took a hit, which was Money Group, spelled MONY, which owns Money Supermarket. And that was quite a strange one, because the stock price went down, but actually they reported their results on Monday, and they reported record revenues. So it's almost like there's a little bit of a disconnect between reality and narratives going on. For the alphabet, I mean, for me, I think they're big enough and ugly enough to come out the right side in the AI race, even if the share price does have a bit of a troubled time if there are questions. But, it's going to be one of the leaders in this space. So you can't see it getting hampered too badly. Chris T, is there anything that would convince you to get in on?
No. So I listen, I might be leaving some gains on the table here, but the point you gentlemen have just made about sentiment being influenced by narratives. I work in narratives, and I know how ethereal and how they can be here today and gone tomorrow. And so basing my investment strategy on that, I think I'm with. There was reports in the FT last week that there's been, investors are seeking shelter from the AI route, in some of those SaaS stocks that you talked about, and we're picking our winners and losers. And frankly, I'd rather invest in more sort of tangible assets at this point: utilities, energy, materials, all that stuff that is not going to go anywhere. We're still going to need all those things, and they're also going to be around depending on what happens with the AI apocalypse, the SaaSpocalypse, or the actual apocalypse, which some people say that AI is going to bring about. So we're still going to need to pump water around or have natural gas and all those kind of things. So look, time will tell. And, the arguments that you guys make about what I'm hearing is that, there'll be certain winners and certain losers. But for me, I'm more comfortable in, there's some things that are just going to remain facts of life when it comes to sustaining an economy, running businesses, all that kind of good stuff. And so that's where I want to put my money. And I think that's probably a safer bet for me. And I'll see some good returns off the back of that, because they're not going anywhere. But we'll see. We'll see what the momentum stocks kind of say. But so far, Ed, you've raced into a lead, so I may be wrong there. But there's some big reporting coming out with Nvidia and a few others post the recording of this, so we'll see if that continues.
Yeah, that's a good point to flag up. We are recording this just before Nvidia, which is quite an important stock, reports its results. So by the time we publish this video, things might be slightly different. But this is where they stand today for us. I think that's a good point to leave us off on. Looking ahead to the next episode, we haven't looked at all of the different bits and pieces in our strategies. We haven't looked at the Stratiphy benchmark strategy that we've got running in the background as well. We might have a bit more of a detailed look at that to see how it differs. But yeah, it's looking perhaps some more of those tangible things, those, the miners, the energy producers, the transportation companies. These are real world economy things that don't rely, like Chris T says, that don't rely on the internet and the digital world, that it seems increasingly fractious and increasingly opinionated on who might win or might lose in those areas. So please do give us a subscribe, like the video, follow along. Let us know your comments. Let us know if you think our strategies are barking completely up the wrong tree, or whether you think we're doing the right thing. We'd love to hear your views on it. If you want to check out Stratiphy in a bit more detail, we have a link in the summary. So do have a look through and see what the platform is like and what it can do. So with that, I shall say thank you to Chris L for providing your insights from the Stratiphy side.
Thank you very much. It's a pleasure to be here again.
And Chris T, thank you as ever for being my foil. We shall see how things get on in our next episode. Do tune in, everybody.
My pleasure, Ed. My pleasure.
Thank you, everybody, and goodbye.